Trying to predict the stock market is no better than guessing if it's going to be heads or tails. I got lucky this time. I first started investing in stocks back in 2020 and often thought, wouldn't it be great to know where the stock market will be tomorrow or in a year? Are there reliable strategies or methods to predict stock prices? What factors determine stock market movements? Or is it the case that all market predictions are useless? If yes, why is the stock market so unpredictable? In this video, I will share what I uncovered as I tried to find answers to these questions based on my investing experience and hundreds of hours spent researching stocks and understanding market patterns. When Google first listed its shares in 2004, a Wall Street analyst famously wrote, "I believe that it is virtually certain that Google stock will be highly disappointing to investors foolish enough to participate in its overhyped offering." Now, some might call that a career-ending analysis, but let's park that to the side. Why did the analyst think Google was a bad investment? There were two main factors. The stock was priced at $85 per share, and using conventional benchmarks, it was spectacularly expensive at almost 200 times its earnings. There was also an expectation that Google's profit would materially reduce in the next 5 years. Now, there was another group of analysts who firmly believed that Google was going to revolutionize internet research and presented a great investment opportunity. A $1,000 investment in Google at the time would have received 11.76 shares, which would be a total of 470.4 shares today, given Google split its stock twice in 2014 and 22. Those 470 shares would be worth $81,703 based on the share price of $173.69 in April. That's an 81x gain on the original investment. Was the analyst wrong? Yes, absolutely. But the bigger question is, why was the analyst wrong? Well, Google was a disruptive business that brought free search to everyone and earned money through advertising. It had the first mover advantage in this entirely new business model. Many analysts made the mistake of trying to compare it with traditional tech stocks and failed to recognize its huge potential and visionary leadership. This process of trying to estimate a stock's intrinsic value using past performance and future prospects is known as the firm foundation theory. Intrinsic value in simple terms refers to the real worth of a stock. This is based on factors such as the company's potential future earnings, the quality of its leadership, and its competitive strength. It is the price that a knowledgeable investor would be willing to pay for the stock if they had complete information about the company and its future prospects. Investing effectively becomes a process of estimating the intrinsic value and comparing it with the market price to make buy or sell decisions. The tricky thing is that no one knows the complete future prospects of a company. Take Tesla stock. There are 41 analysts covering the stock at the time of this video. For the year 2025, the lowest forecast revenue is $73 billion. Whereas on the higher end, it's estimated to make $117.48 billion. The difference between the two is a staggering $44.48 billion. Each analyst has used their own set of growth assumptions. Who will you say is more reliable? Only time can tell. On the other hand, take the Russia-Ukraine war. No model could have predicted it would happen and its impact on energy, food, or commodity businesses and their stock prices. Now, there is a second and overlooked factor which makes the stock market impossible to predict. During the dot-com bubble in the 1990s, there was unprecedented excitement about internet companies, and investors were putting money into any tech startup they could find. During the dot-com hype between 1995 and 2000, the Nasdaq index grew by 582%. Many investors were not basing their purchase of tech stocks on the company's actual financial performance. Instead, they were buying due to fear of missing out or FOMO. One of the famous stocks at the time, for example, was 360 Networks. I bet you've never heard the name. It was a fiber optic company that had a market capitalization of over $13 billion, but filed for bankruptcy a few months later. John Keynes, who was a renowned economist, first proposed the castle in the air theory in 1936. He suggested that stock prices can become detached from their fundamental value. Instead, they are influenced by investor sentiment, rumors, and speculations. He suggested that a successful investor tries to identify future events where the public is most likely to engage in castle building and then buying before the crowd to make money. The dot-com bubble was fueled by investors' willingness to pay increasingly higher prices for tech stocks based on the belief that they could sell them to someone else at an even greater price later on, or in other words, castle building. The rapid rise in stock prices was effectively driven more by psychology and herd mentality than by the company's ability to generate profit and free cash flows. This led to a huge disconnect between the underlying fundamental performance of the companies and their stock prices. And when ultimately the investors realized this, it was too late and the dot-com bubble had already kicked in. The Nasdaq alone fell by 75%, with investor losses amounting up to $5 trillion. Our history is filled with these stories. GameStop shares went from $17.25 to nearly $500 within months. A lot of people got caught up in the hype and lost their life savings. The tulip bulb mania in the 1630s is considered the first recorded asset bubble, and one I find truly fascinating. The tulip bulbs caught a virus which led to various color varieties in their petals, which resulted in high demand, and their cost skyrocketed up to 20 times. At its peak, people started bartering their personal belongings in the hope of benefiting from the high prices. This went on for 2-3 years until the prices got so high that some people thought of selling their tulips to cash in on the high price. This slowly triggered a selling frenzy. The government tried to control the prices and give assurance to people, but that didn't help, and the prices kept going down until the tulip bulbs were worthless and no one wanted to buy them. Now, was it possible to predict a common thing such as a tulip bulb could become a smart investment? Was it possible to predict a 20 times increase in the price or the sharp decline which followed? The answer to all these questions is a solid no. So does this mean we stop investing because the market is so unpredictable? Well, quite the opposite. You see, the only thing certain in life is death, as grim as it sounds. We accept unpredictability in most aspects of our lives, whether that's choosing a life partner or deciding where your next amazing holiday break will be. Mine's probably going to be in Turkey. In 2006, Mark Zuckerberg refused Yahoo's $1 billion offer to acquire Facebook because he believed in a bigger picture for the company. The same intelligent folks at Yahoo who offered to buy Facebook themselves refused Microsoft's offer to acquire Yahoo in 2008 for $44.6 billion. Yahoo was later acquired by Verizon in 2017 for just $4.48 billion. You could say the smart people at Microsoft made a blunder by offering such a high price to Yahoo. The bottom line is that you could be the most intelligent person doing fundamental analysis and finding the best value stock and still lose money. Or you could be a newbie investor who just got lucky riding the wave on the next castle in the air and made money because people were overly optimistic. Either way, don't let success seduce you in thinking you are smart, or failure into thinking you made terrible choices when the outcomes just reflect the unpredictability of the market. Now, if you're someone who wants to save money to invest in the unpredictable stock market, then watch this video where I discuss how I saved $75,000 using my 3-step formula.